everyone. Thanks for joining us. And a big thank you to our speakers today. I'll let Andrew introduce them. Just wanted to let you know that this event is being recorded for educational purposes and will be shared with the Greentown Labs community. Also, if you have questions during this discussion, we just ask that you submit them in the chat. And we will be making sure we get through them during the conversation. And if there's anything else, again, just flag us. There's, we're still learning how to use all of these virtual platforms. But if you are interested in putting your hand up, there's a raise hand feature, and we'll make sure to get through the list. So with that, I will give the virtual mic to you, Andrew.
Great, thank you so much, Maya. And if anyone is having any trouble hearing me, please drop it in the chat so I can be made aware of that and do live course corrections. So thank you very much, first and foremost, to our panelists for joining us today, and to all of you in the broader Greentown community that have made time in your busy schedules to join us. If you're anything like me, you're probably in week 2 or 3 of work from home and in desperate need of a haircut, though I have seen some interesting solutions to get that accomplished across our team and community. So last time, just to give a little quick recap of what we're doing today. So this is the second iteration of our Investor Speakers series. So today we're focusing on impact investing, but last time, I know several of you joining today were present for our first one we had, where we convened Mitch Tyson from CVG, Tibor from the Mass CEC, and Matthew Norton from the Prime Impact Fund, just to have some general advice on just how to approach investment, generally speaking, during this unique time and moment that we're all in now. And big takeaways from that is big focus is on your leadership right now, and investors are looking at all of you, the founders and leadership of your companies, to see how you respond to this crisis we're in. And it's also unclear how long we'll be in this. So it's really important, draw your backup plans on a 1 to 3 year time horizon. And, finally, communication's key. It's important for your investors, your customers, the folks you employ, and your colleagues that you work with. So not to belabor that point too much, but I just want to let everyone know, for those of you who missed this, that this is new information to today. As a follow-up to the discussion today, we'll make sure we include an awesome write-up that Rein on our team put together, capturing the big themes there, and a recording for that session as well. So, keeping all of this in mind, as I mentioned, we're going to focus on impact investing today, what it is, what it isn't, how it's different from conventional venture capital, and, some ways it might be similar. Like last time, we're going to focus on resources and approaches that our panelists are sharing, with their current portfolios, as well as how they're thinking about prospective investments in this unique climate. Of course, the key, the focus of all of our panelists today, and my focus moderating this, is going to be to, bring these resources to the top of your minds and then to share them as a follow-up to the discussion today. But before getting into this great discussion, I want to make sure I quickly introduce our panelists, who I always like to say need no introduction, but I'm going to do it anyway. So first, in alphabetical order, by first name, we're going to go with Adam Rein. So Adam oversees all aspects of CapShift's operations, investments, and technology. He's a founder there. For those of you who don't know CapShift, it's a really cool platform and network that empowers philanthropic and financial institutions, along with their clients, to mobilize capital for social and environmental change. Since 2014, Adam's been in impact for a while. He's been the managing director for Mission Point Partners, which is an impact asset managing firm. And previously, Adam actually co-founded Greentown member Alteros Energies, which recently just had some awesome fundraising announcements and some really cool media coming out on their product, the Aerostat, which is really, really cool. Encourage you to all check that out. And that startup was launched out of MIT to bring low-cost energy and telecom communications to the developing world. So, if that's not enough in itself, Adam's also a co-founder of Greentown Labs. So, we're unfortunately not all sitting will be. And previously, Adam worked as a strategy consultant at Bain & Company. So, Adam has an MBA from MIT Sloan, MPA from Harvard Kennedy School, and a BA from Yale University. So our next panelist, we have Amy Duffuor. So Amy's a principal at the Prime Impact Fund. So we heard from Matthew last time, who's an MD there, and we figured given the theme here, it would be certainly appropriate to also have Amy involved today. So Amy's core responsibility at the fund is, identifying and evaluating investment opportunities. She serves on company boards and she manages companies towards their impact goals. And, prior to her gig at Prime Impact Fund, Amy was a renewables and power investment banker at Bank of America, where she actually, worked with a lot of CEOs of public and private companies to raise investment capital, including the IPO of Sunnova. So for those of you who don't know Sunnova, they're a really big residential solar company. Before her stint on Wall Street, which is really cool, she actually ran an early stage social venture accelerators around Southeast Asia for a Singapore headquartered impact investment firm called Impact Investment Exchange. And she was also a management consultant, but at State of Flux, not Bain & Company, which is a London-based consulting firm that specializes in supply chain and procurement. In terms of academic background, Amy has a BA from Columbia University, MPhil from the University of Oxford in the United Kingdom, and an MBA from the Wharton School. And last but certainly not least, we have Rein Macpherson joining us today. So he's a portfolio and investment manager at the Autodesk Foundation, which is the philanthropic arm of Autodesk, which is a longtime Greentown partner for a number of years. So we've known Rein and most of the panelists here today for a number of years. But in terms of what Rein does at the Autodesk Foundation, so he leads sourcing, due diligence, deal execution for Autodesk impact investments. So much of Ryan's career is focused on, developing new financing mechanisms, investment structures to support the commercialization of breakthrough tech innovations, which is probably best represented by some of the work he actually previously did in investment operations with the Prime Coalition before they raised the Prime Impact Fund. So Ryan's no stranger to impact as well. Back when he was at MIT, he directed the Clean Energy Prize in 2016 and established new technology transition programs within the Department of Defense and General Services Administration. So Ryan has an MBA from MIT Sloan and a BS with high distinction in civil engineering from the University of Virginia. So I think now that I've introduced all of the panelists here, I just, something to keep in mind for everyone in the audience today. Although, all the panelists have mentioned are pretty squarely in impact today, they still have really strong roots in the entrepreneurial ecosystem. Multiple of the panelists today have actually been founders themselves. So it's something I just, like everyone to keep in mind as you're formulating your questions, as the discussion evolves. They definitely do have a both sides perspective, which was a major reason why we reached out to these folks today. And also, I know Maya mentioned it, but we'll be monitoring the chat for questions, and I'm going to do my best to see these as they come in live and integrate them into the discussion. But, if I'm unable to do that and we pull on a really good thread, we will have time for Q&A in the last 30 minutes. So without further ado, I'd love to get into it. So, just kind of kicking this off, I think, it might be helpful to start out with, what is impact investing? I myself thought I understood what impact investing was, but as I started to learn more about the world, I learned it's not so simple. And, maybe Adam, would you like to maybe kick us off with just a little bit of a general drop of the impact
Sure,
investing
Andrew,
landscape?
and great to be here. I will say, after being part of the Greentown community for 9 years, I guess, since we started it, this is unique in that I can see my fellow co-founder Sam White's like high ceilinged living room while we're giving a panel. So Zoom has its advantages. I've been in the impact investing world. Hey Sam, good to see you. I've been in the impact investing world since 2013. And every day people say, what is impact investing? And most people who even work in this space, struggle to define it. But I think that the important thing is 3 takeaways. One is everyone agrees at a high level what the definition of impact investing is, which are investments where the investors intend to do 2 things at the same time. One is to generate financial returns, and second, they intend to create measurable environmental or social impact. And so it's pretty simple that it's the intention of the investor of doing both those things at the same time. But underneath that, people still wonder, well, what is an impact investment or what's not? And there's 2 big subcomponents that are probably good frameworks. One is the world of impact investing covers both market rate impact investments and concessionary or impact first impact investments. And so you can think of market rate impact investments are any investment out there that happens to be, trying to, make as much money as anyone else, but doing so in a way that happens to also do good for the world. And you can think of impact first or concessionary impact investing as opportunities that are likely only going to be funded from investors who have primarily a philanthropic purpose, and they're using the business or the market mechanism to try to create that social good at the same time. And then the second framework that I think is helpful is that it's not to impact investors aren't their own little bucket. It's that for every type of investor class out there, they have their impact type that's alongside of it. So we know about angel investors that we approach. There's some impact focused angel investors in groups like Tonic or Investors Circle. We know about venture capital funds. There is a community of impact focused venture capital or private equity funds that are out there. And in fact, real quick, I'll just leverage the benefit of Zoom by sharing one example of this community, which is called Impact Capital Managers. So impactcapitalmanagers.com. It's a network that just formed 6 months ago to try to have a collection of 2 or 3 dozen of the leading venture capital or private equity funds that explicitly focus on impact investing as part of their purpose. And so you'll recognize some of these names from Bain Capital's Double Impact Fund here in the community, Arborview Capital, another sustainability focused fund, Generation, Renewal Funds, Sustain VC, SJF Ventures, Wave, all of the ones I've mentioned have a clean tech or sustainability focus, as do some others. And so that community is growing. And then, even the other Rein's part of a corporate impact group. You have as well foundation investors which Prime works with frequently. And then CapShift, our team, works with donor advised funds, which also do impact investments. So I think any type of investment class out there, any person or entity that intentionally looks at impact and not just the finance arm is in the impact investing bucket.
Great. Thank you, Adam. We appreciate that helpful starting point there. I wanted to make sure I ask, Ryan or Amy, is there anything else you'd want to add there to that good starting point?
I mean, I think to Adam's point there, right, this is sort of been a niche field for quite some time, but I think you're starting to see impact investing moving a little bit more mainstream as that definition starts to take hold. One of the things that I thought was interesting as you talked about that, Adam, right, is the bread and butter definition has some pretty important components to it. Those 3 components, I think, are intention, measurable, and financial return. And, as you were talking, I was just reflecting a little bit on it, where, all investment capital has some sort of impact associated with it, right? And just whether or not that intention is to make it positive, or if it's just going to be some sort of happy accident. But, your investments can have, negative impact and externalities associated with them. They can be sort of net neutral over time, or you can be purposeful in trying to derive positive impact outcomes from the investments you put forward. Impact investing focuses on the latter, right? When you're talking about measurable, it's holding yourself accountable to those impact outcomes, since it is something that's core to the purpose of deploying that capital. The sector itself has evolved quite a bit and continues to evolve in how we define and measure and manage toward those impact outcomes. Some of the coalitions that really are helping to move the sector forward there is the Impact Management Project, which is worth taking a look at. And the third, Adam, you were talking about the different asset classes of impact investors, but there's sort of the spectrum of capital and financial return expectations associated with doing those deployments, right? And that's anywhere from, sort of a minus 100% investment, which you might call a grant, to sort of risk-adjusted market rate return capital, which you might consider a traditional investment. So those components are really interesting, and it's fascinating looking at the impact capital management, sort of coalition that you showed there, Adam, and thinking about how that might evolve over time as more investors of all different types of asset classes are just a bit more purposeful on the externalities of their investments beyond just financial return.
Great, thanks, Rein. And Amy?
Yeah, no, I think it was a wonderful opening by Adam to really ground us in some terminology and get a sense of the different frameworks, which I think is extremely important. I think one thing to note, as there are more people coming into the space and different types of organizations, which from my perspective is, extremely positive signals. I think, one of my objectives, honestly, is for the impact investing space to move from the margins to the mainstream, is that there are different definitions of impact investing and people view them differently, which both, Adam and Rein alluded to. And so this concept of greenwashing, which is the idea that there are organizations that kind of are riding the impact investing wave and touting impact, and yet they're sort of a happy byproduct, which Rein mentioned. Is that really intentional? Is that really embedded within the mission of an organization? And I think as more people come into the space, those are questions that, we who are representatives of different organizations need to ask ourselves whether that's a strong representation of impact investing. So I think that's just one other element I would want to kind of bring into the conversation and to make people aware of, and also to think through as you start to kind of deepen your journey within the impact investing space.
And Amy, actually, this might be a great segue into my next question, to just expand a little bit more on, how impact investment, the process is a little bit different than conventional venture capital. Would you mind kicking that off, and then we can take it back the other way, Rein to Adam?
Yeah, sure. And I think, to be fair, it's going to be different based on the organization that you work on and the way that you have your process for looking at investment opportunities. So I think to be sort of specific and grounded in an example, let me talk about my experience at Prime Impact Fund. And so, Prime, we're an early stage VC fund. We invest in hard tech companies combating climate change. For those who were at the session last week, you'll have heard that from Matthew, the managing director. For us, we kind of have three kind of key investment criteria, which I think makes us a bit different from other impact investors and then also conventional sources of capital. So I think the first is around focusing on transformative climate impact. So we invest in early stage companies, so pre-seed, seed, and Series A, that have sort of gigaton scale of greenhouse gas emissions reduction. It's a pretty high bar, and that's intentional. There are a lot of companies out there that have incremental improvements kind of within the broader climate tech or clean tech space, which we think is completely worthwhile. That's just not the focus of our fund. So I think that's important. I think, the fact that we generally go at the earliest stages. So Adam mentioned kind of this kind of continuum of both market rate and then also funds that are, impact first. We are an unapologetically impact first fund. That's the way that we were purpose built. And we believe that, the climate impact doesn't necessarily need to be divorced from, financial sustainability or profitability. I think, if we're being honest, there are other funds out there that focus on early stage companies and focus on sort of gigaton scale of greenhouse gas emissions reduction. So Breakthrough Energy Ventures, which is a good friend and co-investor of ours, is one of them. But I think there's a confluence of a number of factors that really kind of makes us unique and demonstrates the different approach we've taken within the broader impact space. So not only sort of the gigaton scale greenhouse gas emissions reduction, but we also have two other elements that are important to our investment criteria, which is additionality, which for Prime means, an investment otherwise wouldn't have been made without our catalytic capital. I should have probably taken a step back and said that the innovation within our fund that is the capital coming in is all catalytic in the form of recoverable grants, program-related investments, which are typical of foundations, and mission-related investments, which are more equity-like structures. And so that we really use that inherently patient capital to de-risk early-stage technologies. And so if a round isn't likely to come together without Prime support, that could be, we are willing to go earlier than others. So, right into university labs for people or for companies where we're the first institutional investor. It could also mean that we've got people at the table that don't necessarily want to focus on climate impact, that's not really their primary motivation, and we can really help them to achieve those goals. There are a bunch of different situations, but we want to make sure that our catalytic capital is ultimately additional. I would say the kind of second thing to also keep in mind is around, we, love going early, but we don't want to fund science projects that want to stay science projects. We want companies to have large scale, enduring, sustainable and scalable climate impact. And we think a good measure of that is the ability to secure follow-on funding. So the way that we operationalize these last 2 points, which I think is pretty unique, is we have this investment advisory committee that we convene once a quarter. It represents, almost 20 kind of the most prolific and active investors in the clean tech and climate tech space. We've got partners from DBL, Breakthrough Energy Ventures, Prelude, Capricorn, the list goes on. And we really ask them during those meetings, kind of abbreviated questions around these last two investment criteria. So I'm simplifying it, but like, would you invest in this company that we're asking for you to review now? If the subset that we've convened say yes, then that's probably not a good use of our catalytic capital, because it's likely to get funded anyways and it's not additional. And then on the flip side, if this company was de-risked on Prime's catalytic capital, do you believe it could secure follow-on funding? If the subset of the IAC members that we convene says no, that's also another useful insight for us, which is that perhaps even if we funded this company, they wouldn't be able to secure follow-on funding from either traditional venture capitalists or strategics. So I think those are a couple of the key distinctions, and the fact that we at Prime kind of have this intersectional approach for how we focus on climate innovations is what I think makes us really unique, and differentiates both from conventional capital sources and then also other impact investing approaches.
Great, thank you, Amy. Rein?
Yeah, I'll pick up the baton there, Amy. And maybe connect a little bit to what you're thinking about there, Adam, because within Autodesk and within our foundation, we're using a donor advised fund, which Adam's CapShift is helping to enable impact investments through, and using some similar investment mechanics and philosophies and criteria that was just enumerated by Amy. I think the thing that's a little bit unique with Autodesk and with our Autodesk Foundation in our impact investing work is that those criteria and how we might differ from other corporate venture capitalists or from venture capitalists really depend on the color of money that we're using and what pool of capital we are investing out of. And so if I put my entrepreneur hat on, I'm thinking about, how to suss that out as you're having conversations with potential impact investors or with any investor as to what the incentives are behind their investment structure and how they're holding themselves accountable to things like financial return on that return spectrum we talked about, impact return and the metrics that we're talking about as a part of this call. But also, the uniqueness of a corporate is usually there's some criteria around the strategic relevance to the company and helping to drive some value within the industries or markets that they are, fundamentally operating their business in. So for us within Autodesk and Autodesk Foundation, the sort of process that we follow is quite similar to other types of venture investors. There's sort of the sourcing and the down selection due diligence part, the deal execution, and a whole hell of a lot of post-investment support and management work that goes in, after money has gone into the companies. But the criteria really differs depending on the type of vehicle that we're using. So if we're investing using our balance sheet, for example, there really is a strategic lens first to those investments, where we have to have executive buy-in, sort of a business unit lead, some clear covenants around what the strategic relevance is of this investment and on what time horizons. If we're investing using a donor advised fund, it's with an impact first mentality. So we're really clear about the expectations of the impact outcomes we want to deliver and how commercial growth for this organization might yield those impact outcomes. So just as a broader point, in having conversations with investors, I think it's helpful to realize that the incentives behind that capital and the time horizons behind those incentives perhaps differ a little bit. Specifically for impact investments, of course, we can use either pool of capital, right? But the incentives are a little bit different. The criteria at the macro level somewhat parallels what Amy just talked about. So ours is threefold as well. The first is, if successful, does it really matter? And that's in terms of the broad, three-pronged investment thesis we have, the impact outcomes we care about. The second is, can this be successful? And that really parallels a traditional venture diligence. So we're looking at the team and at the market and at the technology, the financials, the business model, really getting underneath the hood and understanding the business. And then the third is a little bit unique to us, which is, are we the right partner to catalyze that success? If we have conviction on the first two prongs. Is this the right type of company in alignment for our type of unique form of capital, both on balance sheet or off? And where can we provide enough post-investment support to really be a unique partner throughout the journey? And that takes the form of our technology suite, training on that technology, and our talent through pro bono matching programs.
Thank you, Rein.
Great. I don't have too much to add, but just to take the perspective as a startup leader. So what do you have to do different to approach impact investors? Three things, which is align your company with themes. As Rein just mentioned, translate your goals into impact goals, and then have a plan to translate that into metrics. So in terms of themes, one thing to note is that few impact investors care about technology sectors. They care about impact themes. So for example, an energy efficiency company, the impact investor might look at you and say, no, you're really a carbon reduction company, but your technology approach is energy efficiency. And similarly, a distributed solar company may actually be a helping low-income households reduce their energy bills company to certain impact investors. So, or a sustainable agriculture company might be a enriching the soils company. So I think it's important to look at your business as, how do I touch upon different categories of social good? And then when you look at potential investors, like those logos you saw earlier, or Salesforce's impact fund, or Patagonia's venture fund, you can see how you align with their stated themes that they work on. As Ryan said, everyone wants to know, what does this look like at scale, or how is it transformational? So setting forward that 5 or 10 year vision about how much impact can we create, and many funds like Prime or Breakthrough translate that into the gigaton type of metric. But in other parts of the market, there's other scale metrics. Like we had a company at Mission Point, and it was, how many gallons of sewage are we going to avoid dumping into waterways, if we succeed after 5 or 10 years. And then finally, it's that metric. So I think understanding what are those 2 or 3 metrics you can clearly track, and just keep that in mind for investors.
Great.
Hey, Adam, for you, not to butt in here a little bit, Andrew, but for you, Adam, putting on your Alteros hat, right? Was there any challenges in doing some of that, in sort of translating the mission and vision in the different categories you talked about, or thinking about scale and how the metrics are related to scale might resonate within the impact investing community?
No, and for those folks who don't remember, Alteros launched as an airborne wind company and pivoted to an one telecom company. So our earliest decks, it was pretty easy, which is, you know, just like any renewables company, how many megawatts to hopefully gigawatts of renewables can we deploy if we succeed. And then after we pivoted, we actually had a twofold mission. The primary one moved away from sustainability to enhancing connectivity to underserved communities. But one interesting byproduct was that oftentimes the way we did so is taking very efficient diesel run telecom towers into making them very efficient, centrally generated super towers, which could have up to 50% energy efficiency associated with it. And so for certain investors, we can highlight it, and it was a pretty easy number of units times number of savings per unit calculation to get there.
Great. Thank you. And I actually had a follow-up to that, you know, since Ryan pulled on this thread here. I'm just curious, thinking back to your days, starting Alteros, recognizing that impact investing has come online in a major way since that time. But, is there anything in particular you wish you knew about impact investing back then when you were starting a company that you've learned today that you'd want to share with the community?
Well, like you said, and luck, I think maybe even Ben's on the line and can chime in, but there wasn't these lists of impact investors back then. Alteros's capital is all from traditional investors or angel investors, where the impact was a nice benefit. I think the hardest thing of all is, just like any fundraising, is sourcing. And how do I efficiently identify who's going to be a good fit for us? So I think the one nice thing today is that there are communities that aggregate investors, just like Clean Energy Venture Group does for angel investors in the Boston community. So as opposed to just going, or in the family office world, the Clio Syndicate is the place you go. So I think everyone should be encouraged to look for those nodes where they can easily look at 10 or 30 or 50 potential to find 3 or 4 who might be a good fit and look for intros, versus just kind of getting scattershot and lost in the weeds.
Adam. And maybe switching gears a little bit, but still related here, just recognizing time and wanting to keep this going. So just kind of curious, I know Amy touched on this a little bit in her response to the previous question, but could you expand a little bit more on how you might have more or less flexibility in some areas than conventional sources of capital? Like, I imagine you could in the prime impact fund case be constrained by a really stringent criteria to get gigaton reductions in CO2 emissions, but I imagine there'd be other ways where maybe you do have, it's a little bit different than conventional capital. And would anyone like to take that question, maybe with a little hand raised to kick it off?
Yeah.
All right, go for it, Ryan. Get yourself off mute. Oh, there we go. Cool.
Sure. Amy, I'll pass it over to you after this. I'm sure there's lots of really interesting prime impact fund examples. But maybe just to drive it home with an anecdote, a story. One of these is actually becoming quickly one of my favorite stories about our investment portfolio, which highlights a little bit of the flexibility we're talking about. Is not only flexibility in terms of where you might reside on that return spectrum, the financial return spectrum we talked about, but also flexibility in terms of the type of structure, financial structure you use. And that was highlighted with actually a recent investment we did in a company called Ant Innovation. So for you guys, Ant Innovation is a productive use appliance company that's creating solar home systems and productive use applications for those who are living in poverty in the global south. And we met the entrepreneur, Andy and Kurt, who are absolute rock stars back in 2016. Andy came in off the ferry building in San Francisco, carrying in a brown paper bag, I kid you not, your first sort of prototype of what the solar home system might look like and how they were going to think about scaling this through an efficient production line and through some awesome design and engineering to be able to demonstrably be able to provide energy access to those living in poverty. So I mean, it's a very, very early stages, pre-seed level, where there wasn't much of a company to be able to invest in with impact investment capital. And so at the time, Autodesk Foundation supported Andy and Kurt and the company that became known as Amped Innovation with a small grant, $100,000 or so. Flash forward 3 years, Andy delivered on all the promises that we had talked about before, using a little bit of Autodesk support, and is now doing $3 million in annual recurring revenue and raising a Series A led by the strategic investor Anji that Autodesk invested in using impact investment capital as equity on the preferred ground, and to continue to align our incentives for the long term. So there aren't many sources of capital that can do both grant making and equity investments. But in doing so, right sizing and right structuring the investment capital source for the types of milestones that really are important for the entrepreneur at that time is something that I think is really fascinating, and a lot of opportunity for, I think, other impact investors and funds to start thinking creatively like that.
No, I think that's a really great point. And it's always funny when I start talking about Prime, because Ryan knows Prime so well. So you could also be, giving your experiences with the team. I think, similarly for Prime Impact Fund, I think it's the kind of inherently patient capital that we have coming into the fund, given the fact that it could be recoverable grants or program-related investments or mission-related investments, really allows us to invest earlier and take, I think, what some might perceive as more outsized risks. And I like the example that Ryan gave, so I'll give one of our own from our portfolio. The first company that we invested in out of the fund was called Lilac Solutions. So they're a lithium extraction company based in California. It's really critical for the exponential growth in the electric vehicle market. We invested, $800K. We led the round in November 2018. The largest check, at the time, the team hadn't had any, customers. We were really working with them, quite deeply and hands-on. And fast forward, they just recently raised a $20 million oversubscribed Series A that was co-led by Breakthrough Energy Ventures and the Engine, so MIT's Tough Tech Fund. And so I think that's a good example of how, if you have inherently patient capital and you can come in earlier, help de-risk the technology for follow-on investors, and then have great a billionaire-backed fund, as one partner, and a fantastic fund that was originated from a leading educational institution as another, to really help bring that company to the next level. And I would say in general, we take a pretty pro-entrepreneur stance. So I think that allows us to do some kind of funky things when we're thinking through how to attract really kind of knowledgeable and complementary syndicate partners. I think something else for Prime is, we don't want to go, we generally prefer not to go on things alone. And we want to build strong syndicates because we believe strong partners is going to help bring these kind of breakthrough companies to the next level. And we've been pretty thoughtful about trying to bring together the right types of partners, and believe that's kind of another element for us that we really think is critical for kind of being flexible and creative, both in the types of capital that we have and the way that we support entrepreneurs.
Great, thanks, Amy. Adam, anything to add to that? You've had some time to come up with a good anecdote there.
No, let's. I'll pass.
Sorry, getting myself off mute there. I thought I just about had that figured out. So that was really helpful. I think having those examples, really kind of bring this to life, at least for me, and I hope that's the case for everyone else joining the panel today here as well. So recognizing, it seems like what I understand here is, you do have a little bit of flexibility relative to conventional sources, but I think it would be be bad if I didn't mention, given recent circumstances, we're kind of in the middle of a public health crisis right now. This could turn into an economic crisis as well. How would you say recent events, have impacted all that we've talked about in the front end of this discussion? Are you thinking about things differently? Or is it just more of the same? Because, I could kind of see it going either way. I could see there be less impact capital, or I could see it ramping up in a major way. And we're response to this. So be really curious to hear the perspectives of all of you on this.
Yeah, maybe I can chime in. One, if we look at the work that CapShift is doing with donor advised funds, there's definitely a focus among all the institutions and the majority of the account holders on funding things that are COVID related broadly. So I think that focus is there. I think it's important to split out COVID as two different buckets. One are near-term things that are helping solve a health crisis. And clearly in the sustainability world, there's less of that, although a bunch of companies are pivoting and doing great things. And the second are solutions that are disproportionately helping families, businesses, communities, nonprofits that are disproportionately impacted by the current shutdown or economic crisis. And I think there you see a much broader set of funding opportunities that are related to that, and CapShift now is a giant, pipeline and funnel to help bring those to our clients. And so I think, generally over the next year, any business that can talk about how their business is linked to communities in need right now is going to be beneficial. So for example, Alteros, which does connectivity, can talk about how all of the virtual education has really raised the gap between connected cities and then rural communities that lack broadband access, where you see a number of students that are struggling to get a good education, would be one example. I think the other, and I think to answer your question more broadly, definitely there's more interest in using investments for social good, because social good's on everyone's mind right now, generally. I would note that if you look at the impact investing groups that we have in our network, there is a change of behavior. And I would say the number one change behavior is that, and this isn't all investors broadly are really focused first on protecting their portfolio. So I think what you see is most investors are slowing down new investments and then really thinking about how can they use whatever capital and time they have to make sure their existing portfolio company survives any volatility or economic crisis. So good if you're a portfolio company, bad if you're trying to approach a new investor. Within that bucket, I'd say there are some funds that recently raised money and don't have a portfolio that are less impacted than others. So I think if you're trying to figure out who's still investing, a good sense is someone who, quote, has money to deploy or recently raised a fund or kind of needs to keep investing would be the people to approach, versus ones where they raised money many, many years ago, they have a massive portfolio, they might be less likely to do new investments.
Yeah, I just wanted to pick off from what Adam said. I think that's a pretty helpful kind of framework. And I think on the fund side, at least for Prime, we're about to close our first fund, and so we're looking for new investments to make. And so to Adam's point about people that have recently closed and they're still looking to deploy capital, that's a really good strategy in terms of whom to seek out. I would also state to that, I think in a time like this, particularly for funds that are focused on social and or environmental impact, it's even more important to make investments. We found that at least from Prime's end, because when conventional sources of capital may retreat, given a lot of economic shocks, we know that the areas that we're funding, so climate innovations, that kind of doesn't ebb and flow with the markets. They're persistent existential threats. And we find that it's become even more important for us to have a presence and to continue making investments given the current climate. I think, though, to Adam's point, like portfolio companies also, will be a major focus. I think the first thing when we realized this is not something that's going to be a quick fix was, okay, we've got to go to all of our portfolio companies and make sure, one, the teams are taken care of, the teams and leadership, because that's ultimately the most important is your people. And then, alongside a number of different factors, whether it's kind of existing runway, cash management positions, kind of, et cetera, is really working hands-on with our team to make sure that they have the tools to, more effectively weather this storm. So that's again, something else that we've at least been thinking about pretty deeply on our team.
Yeah, lots of paralleled here. You know, Andrew, you talked a little bit about the health crisis and economic crisis, which I think is playing out as we see. But something that's less talked about, but I think will be equally as important, is the sort of mental crisis that we're going to see in terms of mental health. You know, people working from a home, having to deal with, you know, childcare in new types of ways, fewer or different types of social interactions. I myself am actually planning a second wedding. Wasn't planning on having to do that, but now we're creating another date. So, I mean, people were wrestling with all different types of things that they weren't expecting to wrestle with. So there is sort of the mental component to that as well. And, you know, to what Adam said before, in terms of, you know, all of the companies within Greentown and within the entrepreneurial community, understanding how that fits in the broader context of those three crises, and where you can try to drive some value by being, you know, the rock star entrepreneurs that you are, against the time horizons to go from a response mode to a recovery mode, and to ultimately a resilient mode as a society. So I think there's a lot of ways to be able to plug into that, and to continue to, you know, further your organization's mission, all within the context of COVID.
Great, thanks. And you know, I think maybe, you know, switching gears over to, you know, focusing more specifically on, you know, what resources or general advice you might have for our member community now. I know, you know, Adam mentioned protecting the portfolio is a really important thing right now. So just curious to hear from all of you, you know, what resources are you providing currently to your portfolio companies to get through this? I mean, recognizing it's definitely, all investments are different sources of capital, but are there general resources or tools that and yourself repeating in every discussion with your portfolio companies that you'd want to share out to the team here?
Maybe I'll start there. For our specific portfolio, we are sort of going a little bit insular in the near term, but it's certainly the intention over the next months to continue to get back to business as usual, run our investment committees as we've always been running them, and continue to do new deals, because I do think there is obviously no shortage of fantastic solutions out there, and we have dry powder to be able to deploy. And so for the entrepreneurs that are a part of the Greentown community, understanding that there will be resources available to you, and so not to you know, go inside your turtle shell yourself either. We are setting up specifically a sort of a stability fund for our portfolio companies. Many are seeing some sort of near-term cash crunch. You know, either shocks on the you said demand side, where demand was disrupted through supply chain disruptions or what have you, or, you know, demand disruptions as in more and more people are in need of the services, and they were not in a position to be able to service that increase in demand. And so we're coming up with a stability fund internally to be able to support those companies through the economic shock that we're witnessing. But for others, there's a resource called covidcap.com, COVIDCAP.com, which actually has a pretty good repository from our friends over at Duke that is just you know, about $400 billion available across both global, national, and regional initiatives for entrepreneurs specifically. So I would take a look at that and see what types of new resources might be available for entrepreneurs navigating the near-term cash crunch.
That's a really, really great resource. I feel like Duke has so many awesome resources, Ryan. Like, I'm just floored. I was going to mention another one for the Greentown community. They're also, Duke's Business School is doing a webinar, I think it's next week, around fundraising for sort of impact-focused startups. I think I've sent the details to Andrew, so I'm sure he's sent his around or will. But that might also be kind of an interesting way to hear from experts on some of the unique fundraising challenges for impact-focused companies. I would say that, you know, in terms of how we've been working with our portfolio companies, I mean, there's, you know, some kind of more, I think, kind of standard things around coming up with 3, 6, or, you know, 9 and 12-month scenarios under, you know, a lockdown to see how that would impact your business. Thinking about areas you can kind of reduce, you know, CapEx or OpEx, you know, in a way. I think there's also another element of looking for opportunities. I mean, in every downturn, there's always going to be a small, at least bright light, and thinking creatively with our teams to figure out what that is. You know, whether it's ethically kind of renegotiating with suppliers to extend payment terms or look at contracts. I mean, there are some industries and as well, both from sort of a sector or market size and also geographies that are likely to fare better, or we'll see increased demand or need for output during this environment. And I think just being kind of comprehensive and thinking through those elements as well is really helpful. You know, there's obviously the payroll protection program coming out of the stimulus, which is changing all the time. There are some decks from different law firms that we have in our network that we've used to send out to our portfolio companies, and I'm happy to send that across to Andrew, but I will preface that it is changing quite rapidly, and there's a couple of murky things out there, but I think that's also a helpful resource if you want to come up to speed to see if you can take advantage of any of those opportunities.
Nothing to add beyond what the others said. I will say that with the switch to all virtual, we have had a lot of discussion with management teams around to make sure that that's not taken for granted. I think it can be a very busy time for a lot of companies because everyone's trying to reforecast or pivot in the middle of a capital raise or deal with crisis. And so we try to make sure all of our companies are really thoughtful and aware of how all of the employees or Greentown members are being personally affected, and we're not all robots. So I think encouraging everyone to take time to set aside time for sharing on the team beyond work, and what are people learning through this experience, what are people facing outside of the Zoom box, is really important for teams to stay strong through this period.
Yeah, I like that, Adam. Like, you know, I do think in this type of environment, leadership really does matter, and your true colors start to show when you're being forged a little bit by fire. But you know, to your point there, Adam, I think just having a really true sense of empathy in this type of environment will help to forge relationships that I think pay long-term dividends. And that's relationships with the people you care about in your personal life, the relationships you have with your employees, the relationships you have with your investors. A lot of that is playing out in practice as people are interacting in this new environment that we find ourselves in. And you know, I think you have total control over how you bring empathy to the table and help to forge really strong relationships as we move through this crisis together.
That's great. I think those are all really good points. And I think definitely on the Greentown team, all of what was shared there definitely rings true, particularly the need around communication and checking in on things that aren't just in your work zone box. I know I personally have found that really helpful, keeping my head in the game through all this. And I know others on our team have as well. So take notice. I guess, we talked about a lot of great resources though here, at the front end of this, and then just some great general advice. So I imagine there are going to be some companies who hear about this today and get really excited. And they're like, okay, we've got a really good impact case to be made here. And they're going to start chatting with potential sources of capital there. So I want to make sure I ask everyone here, what can our members do to really position themselves well generally to attract these sources of capital? Particularly what works well is always good to hear. I also think it's pretty interesting to hear what doesn't work well, if you have any of those cases. So I saw a couple of nods there. I don't know, Amy, you had the most aggressive nod. Victory, so you want to kick it off?
Sure. I think the point was made, I think both by Adam and Ryan earlier about, and I think Adam, you emphasized it more, kind of that people have different kind of impact themes, and like you sort of projecting or making sure that you sort of customize based on impact themes versus sectors. I think broadly within the impact investing space, I think that's important, at least for us. I think, it's going to be pretty arduous probably to customize a pitch for every different fund or potential investor, but at least taking the time to group types of investors together can be really helpful. So for Prime Impact Fund, we care about, GHG emissions reductions, and if you send us a pitch deck and there is no mention of impact or no mention of, you know, greenhouse gas emissions, like that's a pretty strong signal to us that you haven't either taken the time to do a quick check to see, you know, what we focus on, but also that maybe this is a standard pitch deck that you're just sending out to everyone and seeing where things land. And given we're impact first, you know, there could be a perceived misalignment of mission, and you wouldn't want that perception to be out there if this is a source of capital that you're actively trying to look at. So I think that's one thing. I think in general, when people give their pitches, and I just might be biased, I really like to hear the story as to why you believe, like how you came to this problem and what you believe your solution is for solving it. I think that provides a much more personal touch. And I think generally what I found both working at Prime and then, you know, I used to be based in Southeast Asia, you know, running early stage venture accelerators for an impact investing firm there, is that really holds true for impact investors. And I think having a pretty thoughtful and in many ways sort of concise story about how you've come to the problem and the solution, and kind of injecting that sense of self can also be really helpful for giving people a more nuanced understanding of your company and also you as a leader. So I think those would be things that I think are helpful.
Yeah, I love that. I think that the alignment with mission is something that's quite unique for the impact investing community. This idea that, you know, there's some sort of problem or an inefficiency or some sort of injustice that bugs you so much that you actually started a company to try to solve this, right? And this is the reason for being. It's why you get up every day. If I'm having a conversation with an entrepreneur and that isn't really clear to me, then likely there isn't much of a impact thesis behind this. Right? There has to be some sort of drive that is going to, you know, help you navigate tough times like what we're facing today to an ultimate goal that yields a better world at the end. So that mission alignment is something that I think is really key. And the other is that, you know, just because we are holding ourselves accountable to impact outcomes, like Amy talked about and Adam both talked about, this isn't an excuse to be able to not have a whole lot of rigor behind the other parts of the business. Like actually, there's still the same rigor bar that's set in terms of, you know, how you think about your operational decisions and your own fundamental financials. So one of the things that's a no-go for me too is, you know, if I start, you know, asking about, you know, sort of the go-to-market strategy and the sort of unit economics and how this is all going to put together, just because we care about impact outcomes doesn't mean that we can sacrifice rigor on the other parts of the business. So it becomes quite clear if both of those are in harmony, then we're off to a great start. If something's out of balance, then we may not be going too far together.
Yeah, I think Amy summed up the key points, which is tailor your communication to the person you're talking to. And that impact investors love mission-driven entrepreneurs where the person really cares about the mission, and that helps them sell, it helps them attract employees, and it's all linked together. The only thing I'd add, one, I hate changing decks for every investor. I think one thing to do is change your intro email and then your messaging as you do your first call. But just from a practical standpoint, it can become pretty painful to have tailored decks. It's personal view. And the second is, I think the other error would be, again, mind you, some investors like Prime are impact first and others are returns first. So I think some people err because their communication or materials is like all financial returns with an impact slide on the end, or like 5 pages about impact, and then you don't even believe this, they have like business ends. So I think the best way to do it is very early on, kind of paint the vision about how your business goals are aligned with a bigger purpose, and really talk about that alignment at the beginning. And then as you talk about all the ways you're going to grow your business, it ties nicely into scaling and aligning the impact.
Great point.
Great, Nate. You know, I think we were already touching on it across the board here. And, you know, just in closing out before we head over to Q&A, and if there aren't questions, I have more questions I can ask myself, so keep in mind there. You know, do you have any just general advice for entrepreneurs that are in the process of fundraising and likely to raise in 2020. I think Matthew kind of, summed it up in a metaphor, as he often does, that, if you're hiking in the woods and you're hungry, don't wait and you see blueberries, like eat the blueberries. Don't wait for something bigger to come along. So I guess, just kind of, keeping that in mind, that all made us smile, which is good and still makes me smile. Is there anything you want to reinforce that you mentioned at the top of this discussion, like Adam did, that you really want to be the salient points of what you share with our community?
Well, I can go off of Matthew's so poignant metaphor. He does speak a lot in metaphors, which is great. I agree with what he said in terms of, in terms of fundraising. It's going to be a challenging environment, but you should probably raise more money than you think you need. If you have come up with a capital plan and you need 500K, like probably double that. In general, things do not go to plan, and there are always different wrenches, and you want to make sure that you have the flexibility to be able to handle those obstacles and challenges as they come. I think it's easy to say, like, raise more money in a challenging environment. So I think I would add on to that, don't just go to the usual suspects. There are a bunch of, different types of impact investors, to Adam's point where he sort of started us off. Think about angel groups like Creo. Think about, foundations with different venture arms like Autodesk. Like, think about, newly started funds. There's a whole kind of swath of different people that you could go to, and I would just not only have the normal like VC fund as your target list, but really thinking much more broadly.
Yep. I think you should plan for 3 times as much money as you expect, and the process to take 3 times longer, maybe even longer now in the environment that we find ourselves in. So start early. I think I mentioned before, a lot of relationships will be forged through this time, and one conversation with somebody about your business creates 1 data point, and 2 conversations creates a line, and 3 creates a pattern, and that trust that's built over time, especially in the environment we find ourselves in, I think is a smart fundraising strategy to take. So start early and have contingency plans for how long that might take.
Yeah, and I just had 2 thoughts. One is it's tricky now because a lot of investors are pausing. And so for people who are trying to close, people are saying, well, we're taking a break. It could be 1 month, it could be 2. So try to build those trusted relationships so you don't waste time. I'm always a big fan of trying to grab a meal with people or some way to connect beyond the meeting so that you can actually get the level of insight into what's going on behind the scenes, particularly in this chaotic time. And I think second is this period's unique because it's not a universal downturn. You clearly have some types of customers and businesses that are actually going to thrive in food or in healthcare, and then other type of customers that are struggling. So if you take renewables, for example, I just talked to a friend, utility scale projects are relatively unaffected. Residential projects are affected. It's pushing residential firms to do virtual sales, which ultimately could be good, help them reduce their costs. So I think being very thoughtful about how your particular business is adapting to this kind of topsy-turvy world, and how you have a strategy to take advantage of these growth opportunities in a overall downturn, so you can still sell that, no, we have the potential to grow. We have a smart way to navigate and still use funds, even if there's a year-long plus economic slowdown.
And would you also say that you're seeing now, I think something I've heard from several members I've discussed with is, if you're raising money last year, the focus was on your growth rate. But now increasingly they're hearing capital efficiency a lot more. Like, how much did you need to get to this point? Like, would you agree or disagree with that as a recommendation for founders to consider as well?
I think it's like a yes and. There's not really much of an either or when it comes to that, Andrew. When we're investing at the earliest stages, Series Seed, Series A, early stage venture capital, like all of us are, we're really banking on the big audacious vision at the end of the day. How you get there is going to require both, some interesting growth and something that can be validated, as well as capital efficiency to make that happen, especially if this fundraising environment extends beyond anything in the near term. So it's a yes and for sure.
Seeing a lot of nods there, so just a general agreement, I would suppose. It depends and often does, as I ended grad school after I thought I would derive some universal truths. Great, so I think we can kind of hop into Q&A here. I think we already have one question from Manir in our community. So I think question for you, Ryan, I think you might have already seen it, to what degree are you, integrating your goals at the Autodesk Foundation, more broadly within the organization? I'd be curious to hear that.
Yeah, we're sort of an N of one, right? So I can't speak for a lot of other corporate foundations or corporate impact funds or corporate venture capitalists, but speaking to our specific case study, the foundation actually sits, within the organizational structure of Autodesk. So we're underneath a group called Brand Strategy and Marketing. So we have a connection and a close connection to the company, including the strategic goals and both long-term and near-term. My board of directors are all the senior executives of Autodesk, and so we have a direct line of governance associated with what we're doing in terms of impact outcomes, plus how the company is performing on its strategic intent. And so we have a unique sort of tie there. Maybe I can bring this forward with a recent investment we did that used the balance sheet. So it was led by our corporate development group, but it was a close collaboration with myself and our corporate development team in a company called FactoryOS. So FactoryOS, if you're not familiar, they're based out in Vallejo, California. They are manufacturing homes in a factory floor setting, and in doing so, trying to drive down the consumer paid cost of housing. So it's a modular prefab type of play. We call that industrialized construction within Autodesk. Very core to our strategic interests in the convergence between manufacturing and construction. We see that sort of playing out in practice with our customers. Really interesting strategic investment. It warranted using the balance sheet and a larger check size to be able to try to realize some of that potential value. But some interesting sort of externalities in terms of impact that we care about as well. And so how do we hold ourselves accountable to those? So the deal covenants with this were not only focused on what sort of strategic relevance do we think FactoryOS has with our partnership, but what kind of impact outcomes can we hope to derive through this? And that includes, lowering the consumer paid cost of housing, doing so in a way that uses materials that have a lower embodied energy and uses actually unionized labor. So to be able to provide some upskilling opportunities for the labor force itself. So there's a really interesting connection point there. A lot of it plays out in practice on the individual deals, depending on what we want to drive forward with the deal structures we have, as well as the governance that exists with the foundation. So.
Great. Now, I think that was the one question I had in the chat there. If anyone has a question they'd like to ask live, I'm also willing to offer that opportunity if I get a hand raised.
I've got a question for Amy.
Oh, I love that, Ryan.
Amy, we chatted a little bit before about, and you said it in your sort of opening statements, but I'd love to talk about it, parse it out a little bit. You mentioned sort of the stigma that might exist for companies that are quote unquote impact companies or looking to raise impact capital as potentially being, not a fit for commercial capital. I'm curious if you've seen that at all at Prime, and if maybe you have, some recommendations or some thoughts for how entrepreneurs should sort of approach that type of stigma.
Yeah, so that's a great question, and I think I will be leaning a little bit more so from my prior experience in Singapore and impact investing than Prime to answer that question. I would say that in general, and it's actually a two-pronged issue. It's not only focused, I think, on the entrepreneurs, but also on the impact investors, particularly ones that are now not associated with sort of more mainstream funds, as they've as the TPGs and the Blackstones have started to come into the space. But I think Adam had a nice example of that earlier, which is, starting out your pitch or whatever with your story, but then kind of demonstrating how that is really aligned with kind of the business elements and the business fundamentals. I think that's really important. We always say that it's depending on what type of investor you're going towards. If you're going to a more, traditional or market rate investor, then, you talk about the impact, but you really focus on the business fundamentals. You talk about the traction that you've gotten in the market. You talk about how you have strong unit economics. You talk about all of the, the customers and like the price discovery that you've done, like things that they really care about, which I think is important. And I think too, some entrepreneurs, particularly when I was in Singapore and around Southeast Asia, were pretty reticent to be known as like impact companies or social. I think it was like social enterprises, social ventures. Like the terms are always going kind of in and out of vogue, but there was some reticence there to be known as that because they didn't want people to think that they weren't as rigorous, that they weren't focused on financial sustainability. And in some ways, I wouldn't say we would necessarily agree with them, but depending on the audience that they were speaking to, we felt that that might not be the most appropriate thing to lean on. I think from a fund perspective, it's interesting for me joining, Prime, which is a nonprofit coming from a bulge bracket investment bank. I think even we as a fund have to, have to also clarify that, when we are making investments, we actually make equity investments. We're not making grants, which we think it's completely worthwhile to do if you have the ability to do both, as you mentioned before, Ryan. But that's just not necessarily our remit. And I think sometimes, we also have to demonstrate the kind of rigor and the fact that we are backing, what we believe to be breakthrough innovations in the climate space, and that we're not taking, any shortcuts just because we come from, an impact-focused lens or, a nonprofit-focused angle. I think that's been pretty important. I mean, an easy way for us, I think, from an organizational level to address that is, one, through the companies that we back and being really rigorous in our diligence processes. And then secondly, I think is also the co-investment and the follow-on investments that have happened. I mean, I think Prime Coalition has done an exceptional job of creating a network of investors, both when they were doing deal-by-deal syndication prior to the formation of the fund. And also we've tried to continue that tradition with the fund, whether it's, like we said, Clean Energy Ventures or Breakthrough Energy Ventures or, Data Collective followed into one of our companies. So just making sure that, you are the company you keep, and we care about ecosystem building and building strong partnerships, complementary partnerships. And I think that's another way too, at least from the fund or organizational perspective, that you can demonstrate that, this perceived kind of negative lens of being an impact company or an impact organization.
No, thanks. I didn't mean to put you on the spot there, but I love the answer. It's a kind of, actions speak louder than words, and you got to walk the walk. And that happens on both the entrepreneur side and on the investor side. So it's setting that high bar and going to achieve it. And that in itself speaks louder than any sort of categorization you might get put into it.
I'm curious, now that you asked that question, I'm sorry if this was touched on, maybe I might have missed it, but do you ever see, in your experience, companies might have raised money from conventional venture capital and be a really impactful solution that, you're less excited about because of their capital sources?
That's an interesting question. I don't know if I would, I guess I would phrase it differently. And I think, for Prime, the additional element, like the additionality criteria, means that we want to think about the highest and best uses of our catalytic capital. So, as an example, if there is an oversubscribed Series A round with Coastal Ventures and Sequoia and Breakthrough Energy Ventures at the table, so you've got both commercial capital, but then you also have a very large investor, but that does also have a climate impact lens. So that again that's probably not the best use of our catalytic capital. But I would say that it's really case by case dependent. And it's hard to have a completely hard and fast rule around that. But additionality for us does mean that we look at the circumstances of the round and a company with a bit of a different lens.
Andrew, I have a question for the panelists. And sorry if I may be the only person who's asking.
Yeah, Munir, go for it. I thought I got your question, and I thought that was the hand raise, so please ask away.
Oh yeah, no, this is a two-part question for the panelists. And the first part starts with, and having dealt with investment bankers in the past, investment bankers will come and say, okay, here is a suite of possible funds that can invest in you. And by the way, here are some impact investment funds, but by the way, they're going to take more time and more effort. And so they do sort of put them in the back of the line oftentimes. For that reason, and really I'm realizing that it's not sometimes in their interest to put impact funds on the front burner. The second part of that question is, do your terms, is there something in your terms that differs from conventional, financing, conventional investment offers?
Sure. I can start, since I felt like there was that direct investment banking reference. Yeah, I know some investment bankers can just be they're just can be really tough, problematic people. But no. So I think your point is right in that I think the incentives may not always be aligned depending on the bank, depending on the client, the company that they're raising capital for. Investment bankers may make most of their money off of fees. And so if you are a smaller fund or you don't have an ability to pay as high of a fee, then just in terms of the sheer volume of transactions that they're looking at, it means that it probably won't come to the forefront of that list. I think the difference depends, at least when I was in banking, when we were working, not the Sonova deal, but there was another deal that we worked on where the CEO of a pretty large kind of impact focused kind of investor really insisted on going to impact investors first because they felt like they would get the story better. And actually it would just, that and in that instance, it would be easier to streamline and things would actually move faster. So I think that depends. On the terms element, every investment opportunity is different. I think that some conventional venture funds might have a pretty strict like pre-valuation that they won't go above, say it's like 3 or 4 million. We don't have that, but that depends on the events. I think it really depends on the company, the circumstances, and the stage that they're at. But in general, we try and be flexible to do things that really maximize the success of a potential company. And I think we think about it that way because we are an impact first fund. And that means, just from a candid perspective, our management participation, which is our form of carry, is aligned to impact metrics. It's not aligned to financial metrics. So even if I support a company and they have, an IPO where they get acquired, but they don't achieve any of their impact goals that we've set out, I won't receive any of that carry. So I think we're trying to be thoughtful about really aligning incentives and making sure that sort of pro-entrepreneur and achieving those climate impact goals are first and foremost. But I will stop and let others respond.
I'll just chime in that I think that the difference in how much time it takes for an investor to invest is mainly driven by lots of other factors more than are they an impact investor. So for example, corporate investors will generally be slower than individual angel investors. And that's going to be true for a corporate investor and an angel impact investor. And then in terms of different terms, the main groups that do different terms are impact first funds, like foundations doing program related investments, where they might have a side letter that actually requires the recipient to meet certain impact standards. Other than that, I think you see the same mix of terms as you see from all types of investors.
I think unless Ryan has anything to add, I want to be cognizant of time. I see a nod there that we're good. So I know we have some hard stops at 1:25 today. So I just want to make sure giving a big thank you to the panelists for their time today. I don't want to risk a virtual applause because we've already, I'm sure, tried to sing happy birthday to some folks over, and that can do crazy things to the microphones. You know, just in conclusion here, I just want to let everyone know who's still on the call here today that all of the panelists today have confirmed office hours next week. So I believe Ryan is next Wednesday, the 15th in the afternoon, and Adam and Amy will be on Friday the 17th in the afternoon as well. So those will all be going out in the newsletter. We'll also include links as a follow-up to our discussion today, just so you can have those, and feel free to share with others on your team that might be most appropriate to join. Also want to make sure I'm mentioning in the chat, I know Adam mentioned he's a co-founder of Alteros, and actually his co-founder, Ben Glass, will actually be taking part in a founder speaker series that we are launching next week on April 14th at 12 p.m. So we encourage all of you to join those, including the panelists. I heard consistent mention that the story is a really exciting thing to learn about, and this is certainly a good one to kick off with. And, you know, other than that, I think that's pretty much all I had. And we're really thankful and appreciative again to the panelists for your time today. I think this was some really great insight, you know, not only for our core team to take away and share out with our member community, but also for the members themselves that were able to join today. And it's really nice to have that recording so we can make sure all the founders that are busy managing childcare or their businesses more directly can pick this up at a more convenient time. So with that in mind, I hope everyone has a great Friday. And for those of you that are celebrating holidays this weekend, I hope you find a way to be close to your families despite the physical distance. And with that, take care and have a good Friday. Signing off.
Andrew.
Thank you.
Thank you so
Take
much,
care.
Andrew.
Bye.
Maya.
Thanks, everyone. Thank you so
Bye,
much.
everyone.
Bye-bye.
Take care.